Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about the psychology and anatomy of a spike. Now, what do I mean by a spike? What I'm looking at is when there's a large spike in price, whether it's based off of a news event or somebody said something somewhere or whatever the case may be. Spikes can give us a lot of information. Now, there's no, you could make a clearly defined way to kind of break down what a spike would be, like a 2% move or something like that. But realistically, it's any large candle that stands way out of whatever else happened. As an example, it's fairly obvious to see the spike candle here on gold. It's this big bad boy right here. You could also say that one right there, maybe even that one right there. And then as it went into the next day, you had this one, but it followed up with this one, and then it finally started giving an idea of what was happening. So that's what I mean by spike candles. They're way, way bigger than what's happened previously. Now, we can use these spike candles to our advantage to locate major areas of support or resistance. Some of the levels of support or resistance can be, honestly, some of the best locations when you're talking about areas of interest on big spiking candles, especially after there's proof that the spike has put in a low or a high, etc. So what are we looking for? Well, I'm looking for a big blow-off. Up, down, it doesn't really matter which direction. We just need to see the market break out in one direction or another and then pull back on itself. Typically, the type of breakouts that I want to see and the type of candle formations that I want to see are big bodies, but I like seeing big wicks, right? That makes it a lot nicer because that adds a little bit of proof into what I'm going to be talking about here in a second. So what we're utilizing these spike candles for are levels of support or resistance, and the areas of support or resistance become on the extremes of the candle or the extremes of the move, depending on how long it lasted. So here's an example. We have this big giant blow-off candle, and we also had this one right here. There were two. So realistically, we could measure both of them and say, all right, well, there might be a level there or there, but there might be one here or there. Or the way that I would approach it would be both sides of it right there. So what I look for is the market to come back to that zone and see what the response is. So if we draw a line on the bottom, and then we'll draw a line on the top, and then we'll also put one over here and see how the market responded. Now, I don't think I need to make it very obvious, but right there, something fairly interesting happened. Now, if we zoom into a faster time frame, like a 1-minute chart, and we go back to that same location, so let's go back a little bit here, and look for that spiking candle to take hold. A little bit further. There we go. All right, so when the market came down and they hit that area, it immediately rejected and popped back up again. Now, that's the type of reaction that I want to see. I want to see the market show support there. We already know there was support there, otherwise there wouldn't have been a giant wick. That's why I like the ones with giant wicks, because it's already kind of increasing the odds that when the market does come back, you're going to see a bounce. Now, the cool thing is about these is that it's not just for one day. It could last for a long period of time. But why these are interesting is because when we have that giant spike down and the market comes back and retests it, what's going on there? Well, think about what happened initially on the move. Whoops, that was a weird time frame. What happened initially on the move is people were surprised. Nobody's really expecting to see some ginormous move out of the middle of nowhere. So what ends up happening is you have that initial drive, and then it pulls back, right? You have sellers that may have been stuck, or in the case, since we're talking about a short, you have that big push to the downside. You have buyers who are stuck way up here. They weren't expecting to see that giant flush in price, so they have to reposition. A lot of traders will just simply exit, take the stop. That's fine. Larger hedge funds and large contract traders, they don't have that capability. You can't just drop 1,000 contracts on the market and hope for the best. The market has to let you out. So the easiest way to have the market let you out is to draw your average down so that it bounces back up and you can exit around break even plus or minus a little bit. So what ends up happening is you have that initial flush down, you have a flurry of buyers coming in here, that's sellers taking profit, but you also have buyers who were stuck before who are trying to reposition their average. So they're trying to draw their average down, and what ends up happening is the market bounces back. Now that bounce back, this is where things get interesting because one of two things is going to happen. This is either a complete failure and the market goes just screaming to the upside, or this is a continuation bounce where once all of those buyers have exited, or once they get in and they buy more and accumulate, that draws their average down, and it comes back to their break-even point. Well, if they were taken by surprise and they don't want the trade anymore, what do you think they're going to do at break-even? They're going to dump it, right? So all the buyers that propped the market up, that created that wick on the bottom, they just got out of the way. Nobody's left to hold the market anymore, and you see a continuation move down. Usually the continuation move is a little bit of the higher probability, but not always, and that's why both sides of the candle become levels of support or resistance, or the move, etc. So here we have a giant spike down. Don't think it's very difficult to find the support there. Very nice bounce off of that 1493.3 area of support, but that in turn created another level of interest. So here again, we have another spiking candle. Now the majority of the spike happened on that candle, so we can draw just that candle. But realistically, it never even made a new candle's low until way the heck up here. So this whole drive up could be one big level of support or resistance if the market decides to come back. So you want to keep an eye on both sides of that. Now, as the market starts breaking out, I don't know that it has ever come back far enough to actually hit that level of support. Oh, it did, actually. Back to the highs again. So 1496.8. Several days later, it acts as support. And this is what I'm talking about, right? Just because it's been a day, 2 days, doesn't mean these levels disappear. Remember, we're talking about a huge amount of contracts that they have to slowly piece their way out of. And, well, if it takes a day, cool. If it takes an hour, that's fine. If it takes a week, that's going to work out too, right? So that's kind of the idea of why you want to keep an eye on those extremes on spiking candles, whether it's news or whether, I mean, anything. It doesn't really matter. Now, aside from the high and low of those being an area of interest, you can also utilize them to measure up where potential objectives may be. Now, what I mean by that is we can measure the initial spike, and that will give us an upside target, in this case, because it's bullish, that we can look for. A couple different ways to measure this up. First of all, would just be measuring the big candle that kind of started it all, right? This guy right here. But like I said earlier, realistically, this spike didn't stop, right? It just kept going. It never even broke a candle's low until way up here. So this whole spike up could be the measurement, right? And that means that we're looking for upside objectives, in this case at 1506.7. Now, there wasn't much of a response there, to be fair, but you can still see, look at the amount of profit taking that took place on those wicks. Once the market broke back above it, then it kind of kept going along. And because it's going to disappear when I move the chart, let me just put a line on it. But as the market came back, this is why you don't delete those levels, because it acted as major support, major support, major support, broke down, major resistance, broke back up, major support. That's why these levels are so important. And even a day or 2 days later, more support, came back again. This time around, it found support and then finally broke through. So that's why, first of all, you need to look at these different locations in terms of, you know, levels of support or resistance, but they can also give you nice projection areas to gun for, where those buyers may be looking for. Now, that could go off of the backs of any large or extended overdone move. And it's got to be strong. You know, like right here is an example. Yes, that's a very overdone move, but it's not like it all happened in one candle. It's just several consecutive small candles all the way up. Nothing out of the ordinary. We want to find those big spiking candles like right here. Pretty obvious to see this gigantic candle right there in the middle, and then one followed up right after it. Those give us the areas of support or resistance that we want to keep our eyes on. So if we're looking at those as the major levels of congestion, I guess is the best way to put it, as we go forward, we'll mark those up and see what happens when the market comes into those areas. Came into the first area, found a lot of chop and slop, but overall ended up being support. Market came back, failed as support, turned into resistance. Resistance, resistance, resistance. Finally broke back above. Guess what? Lots of support. Broke through that one, acted as resistance, then went to the next one. Good chunk of support that stalled the market for a solid 20 minutes before falling to the next one, which ended up as very good support as well, not to mention the resistance at the high. So these levels can give you some major zones of interest, but if you're looking to measure them up, you have to approach it a little bit differently. You're looking for those big spiking moves, but you're looking to utilize that spike as a whole as a measurement of where the objective on the markets may be. So here we have a very strong up thrust, no follow through, right? Tried breaking out through the highs, just a complete and utter failure at the top. But when they rotated back over again, a very strong breakdown occurred. They almost lost the grip on that one as well, but did eventually come back down. So we can use this spike down to our advantage and say, hey, you know what? This big jump to the downside started here, ended here. You could even stop on the close of the candle. But you're looking for downside objectives off of that, which would be the 100%. So if we pop that up there like that, we'll look at what happened when the market came down. Actually, it hasn't quite gone far enough, or it's off my screen. Yeah, it's off the screen. All right, let's put it right there, and then we'll go forward. So here we have a near test. They bounced up, broke out. Every time we've seen one of these areas hold the support, then break down, what do you think's going to happen? This 1505 area is now a new level of resistance. So come back, watch the video a couple weeks later and see what happened here. But that's the idea of what we're looking for. They give us ideas and locations to look for, objectives to go for, and sometimes just massive levels of support or resistance that a scalper could have a heyday with. So that's going over the psychology of a spike. It's basically just people being taken by surprise and trying to very quickly reapproach the markets with this new information, whether it was, President Trump saying something crazy or whatever. But the idea is still the same. People need to reposition. People need to go about adjusting their positions that are open that they were surprised on to make it so that it actually still fits with what they need, or they need to exit. Either way, a lot of interest, you can be sure, will happen at the highs and lows of those spikes, so make sure to keep an eye out for them. That's going to do it for this one, though. I hope you found it enjoyable, interesting, maybe something you can add to your tool belt if you're not looking at them already. As always, if you have any questions, send me an email, jbrink@slingshotfutures.com. Don't forget, underneath the video, throw a thumbs up on the video, show us that you like it, subscribe to the channel so you don't miss any more of the videos that we put out generally every day. And that'll be it for this one, this edition of Psychology of Spikes. So that's going to do it. I hope you had a fantastic day of trading, and we will see you all tomorrow. Thanks.